When someone says you could potentially make infinite money, you're probably imagining yourself sitting in front of a printing machine and printing money until the end of time, right? But no, that is not what I meant. I meant the possibility of making infinite amount of real money without having to push the inflation up. You don't think it's possible? Let's see. Let's say someone had Microsoft stock at the beginning of 2020. When the COVID-19 pandemic led to a market crash in February and March, they may have lost more than 35% of their money. That's because Microsoft stock fell from a high of almost $190 to a low of $120. But at the same time, there are people who made millions of dollars from the crashing market. When the market started coming back up in late March, while the same person holding Microsoft stock may have seen an increase of more than 50% in their stock value, there are other people who potentially made over thousands of percent from the same stock, but in a slightly different way. Curious to know how they may have done that? Now, there are a few ways to gain such quick, huge margins on the stock market, but in this video, we'll be looking at one of those ways, which is trading stock options. We will look at what stock options are, how stock options work, how stock options can be traded for profit, and how stock options can be possibly, or more appropriately, theoretically, used to make infinite money. So make sure you stick till the end so you do not miss anything. If you ask the internet what stock options are, 90% of the time, you'll end up confused. That's because the information out there is too technical for everyone to understand. Since my idea for this video is not to confuse you, I'll try to explain it in as simple a language as possible. So stock options are basically contracts which will allow someone to buy or sell a particular stock at a predetermined value within a predetermined time frame. When someone is buying or selling stock options, they're fundamentally buying or selling the right to buy or sell a particular stock at a predetermined value and within a predetermined time. So you're not buying any actual stocks when you are buying options, but you're only paying a premium or a price to obtain the right to buy or sell a stock. If this is not clear for you, think about it this way. Let's say, for example, you're looking to buy an apartment, and one day you go to your friend's place for a party and realize that his place has everything you're looking for. And what more? It's also close to your work, so you don't have to drive too far. And surprisingly, your friend tells you that he's looking to sell his place, but only after 6 months. You like the place so much, you don't want to give up the opportunity of buying it. And you think that property prices may be going up in the next 6 months. So you ask your friend, "Hey, I'll be down to buy your place. Would you be willing to sign a contract to sell this place to me for $100,000, which is the current market price?" And he says, "Sure, why not?" So now, you have the right to buy your friend's place for $100,000 within the next 6 months. So even if the property price goes up to $150,000 in the next 6 months, you'll still pay only $100,000. What more, you can even sell the place as soon as you buy it and get a profit of $50,000 right away. Sounds great, right? This is the fundamental idea behind stock options. When someone buys stock options, each options contract gives them the right to buy or sell 100 stocks. This means by just paying a small amount of money for one options contract, they can have access to 100 stocks. There are mainly two different types of stock options: call options and put options. If someone is buying a call option, that means that they're betting that the stock price is going to increase in the future. And by buying call options, they're buying the right to buy the stock of a company at a predetermined price within a predetermined time frame. This predetermined price is called the strike price. The strike price is chosen by the buyer of the call option such that it is lower than the eventual stock price which they believe the stock would be going to reach. If the stock price of the company does increase and goes beyond the strike price of the call option within the time frame, then the buyer makes a profit as long as the money made from exercising the call option is more than the money spent on the premium and brokerage fee. If it is not clear for you yet, let us look at an example. Let's say the current stock price of Mr. $60, which by the way I heard is an absolutely amazing company, is $180. If I am confident that the stock price of Mr. $60 is going to increase in the next 60 days to more than $185, I can buy a call option with a strike price of $185 and an expiry date of 60 days. Let's say the price of the options contract is 50 cents. It will cost me about $50 to buy the option plus any brokerage charges, which let's say is around $50. So I'll be spending a total of $100 for this purchase. If the stock price does increase, and it magically goes up to $200 in the next 60 days, which is an increase of approximately 8% compared to the strike price, then the price of the option would go up to $15 if the delta value of the option is 1. Now don't worry too much about what delta is. Just note that delta is something that will tell you how much the price of an option will increase or decrease with an increase or decrease in the underlying stock price. Anyways, at a price of $15, the profit margin I would be getting on this options trade is a whopping 1400%, since I had just spent $50 for the call option plus a brokerage fee of $50. So, if I had to make $1 million from this trade, I could have easily done it by investing approximately $34,500. Since theoretically, the stock price of a company can increase as much as it can, there is a theoretical possibility that someone can make infinite amount of money buying call options. But this is not practically possible for obvious reasons, which are no stock price will ever go up anywhere close to infinite, and there's a time limit after which the option expires. Now on the other hand, if someone is buying a put option, that means they're betting that the stock price is going to go down in the future. And by buying put options, they're buying the right to sell the stocks of a company at a predetermined price, which is the strike price, within a predetermined time frame. The buyer chooses the strike price of the put option to be higher than what they think the stock price will eventually go down to. If the stock price of the company does decrease and goes below the strike price of the put option within the time frame, then the buyer makes a profit as long as the money made from exercising the put option is more than the money spent on premium and brokerage fees. Unlike buying a call option, buying a put option will not provide the buyer with the possibility of making infinite amount of money because the stock price of any company can only go down to as low as $0. Although there is a lot of potential in stock options to make good profits, there is also risk involved, as with any other investments out there. And no one should be playing around with stock options without actually understanding how they work and understanding the potential risk involved. Any options trade will involve a bear and a bull. In simple terms, a person who is betting that the stock price will go down and a person who is betting that the stock price will go up. In a call options trade, the buyer is bullish of the stock price and expects it to go up in the future, while the seller is bearish and is expecting that the stock price will go down. On the other hand, in a put options trade, the buyer is bearish of the stock price and expects it to go down in the future, while the seller is bullish and is expecting that the stock price will go up. So as you can see, rather than just trying to buy call options or put options, one can also choose to sell or write the call options and put options. But I do not want to provide too much information and confuse you, so I'll save that for another video. If you would like to understand how selling or writing options works, just make sure to subscribe and press the bell icon so you'll get notified the next time I post a video. So that's it for this video, guys. I hope you learned something about stock options and also understood that infinite money is not practically possible, unfortunately. Do let me know in the comment section if you have any questions. And for those of you who are still here watching this, thanks a lot for sticking till the end. It means a lot to me as I spend a significant amount of time making these videos for you guys. So please leave a like and subscribe if you would like to support my channel. It really encourages me to work even harder and keep improving my content. Thanks again, and I'll see you guys in the next one.